Okay, so mid-year economic and market update. And again, we're going to do these this webinar series, I should say, every month, the third Tuesday, and at the same time. So next topic, it's just going to depend. We don't want to commit to something right now. We really want to figure out, like, okay, what's going on, if there's more issues with COVID, more issues with the economy, earnings, things like that. So we just want to be as flexible as we can. And again, if you have ideas, I know the topic I did last time, if I were president in 2020, I got a lot of feedback, mostly good, so I appreciated it. And it was totally different, kind of a little bit off the cuff, but it's actually fun to do things that are a little bit more outside the box. I enjoyed pulling that content. So if you have some things that, again, you think that would be useful to have some dialogue about, I'm happy to. So one of the things when we go through this topic today, just quickly on just disclosures, obviously these are my opinions. I did pull a lot of data from Raymond James, from their resource team, from their strategy team. So you'll notice a lot of the disclosures will have come from them. So they pulled a lot of great data. I cut down their presentation by over half because it was just way too much. But I try to pull the big things out that I thought would be very relevant. The slideshow will be available, I believe, on our website or through an email. Tara will know that better. So she'll follow up with you as attendees. And then additionally, we'll be posting this video on our YouTube channel. So if you haven't liked our YouTube channel, please do, because that way, if you miss a webinar and you want to just catch up on it and you want to do it on your own schedule versus at the set time, you'll get notifications that we've actually pulled up or that we've posted new content. So please follow us or subscribe to our page on YouTube. Okay, so pretty simple agenda for today. So we're going to go through market volatility. We're going to talk about the economy. We're going to go through kind of the policymakers' response, like what's going on in Washington, and we're going to talk about equities, meaning the stock market. So that's the agenda for today. I'm going to address these and kind of take a pause as we go through. So I did get a political question. I might have to save that for the policymakers' response, but we'll see. We'll see what I'm in the mood for today. All right. So market volatility. So we all know that what happened looking back now. So we all have the benefit of hindsight, right? We can look back and say, wow, that was a crazy 4 months of uncertainty that we lived through from the time we started shutting the economy down to the time of, the markets melting down and recovering. So clearly we all know, especially here in California, that we're closing back up. Not as bad as we were at the outset. We have a little bit more clarity. But still there's a lot of uncertainty, but this last 4 or 5 months was really chaos. And it's really just defined as a black swan event, meaning something that is so out of the ordinary, something that's not part of the normal investment landscape, but we know these things will happen. Now, black swans I don't know what technically they're how long they're actually supposed to last or how infrequent they're supposed to occur. I feel like even in my short career of, nearly 23 years, that we've seen 3 of them. We had the internet.com bubble, and then we had the financial crisis back in 2008, and then just what we went through with the shutdown and the markets melting down. So now that we can kind of look back with hindsight, I think it does kind of remind us that we don't want to panic. I do have some kind of words of wisdom at the end that we can discuss. But it's always easy now to look back and say, okay, that wasn't that bad. Well, 4 months ago, it felt that bad. And it's nice looking at markets recovering. Panic has subsided, but we still aren't out of the woods. We still have some challenges. And I'm going to definitely spend today talking about some of the headwinds, some of the things we're positive about, and just do my best to kind of share the data and what's happening, all knowing that this is changing, right? Our outlook for what the economy reopening a month ago was very different than what we're dealing with today with the spike of the cases that we're seeing in most states. So, kind of if you look here down at the bottom line is that we do expect volatility to be the norm. I know it's kind of a broken record when I say that, but volatility is not going to go away for many reasons. The way that information is being processed now is so fast, so it causes markets to be extremely volatile. Additionally, going into an election year, the uncertainty of what's going to happen with this election and the tax changes and the tax policy adjustments that might occur depending on who wins is definitely going to be a cause for market stress, market volatility. The thing is, we don't view volatility as a bad thing. Now, as an investor, we don't like it. When you go through a period like we just went through and you have, let's say, $2 million invested, and you have a correction of 35% in 5 weeks on a $2 million portfolio, that's $700,000. And so I'm not trying to diminish volatility, but volatility is just something you sign up for when you invest. And the reason why we asset allocate is because we have to have different assets in different places, and we deal with volatility. Volatility is a normal, healthy part of it. And I think we all have to start realizing that it's not like, what's causing this? Why is this doing this? Should I be freaked out? It should just be kind of like, that's normal. We don't know what the volatility, what's going to cause the volatility. Something is always going to be there, whether it's a war, whether it's an interest rate policy, whether it's a change of presidency, whether it's a health crisis. There's always going to be something. And for us to try to guess what that future is going to be, it's a fool's errand. It's not good use of time. And while I love having engagement of what my ideas are, what my philosophies are about where things are going to go, the most important thing is you got to have faith in the long-term investing discipline. We all look at real estate and being a long-term stock investor is something that we do. And over time, we're going to have success. And so volatility is just the noise that does create stress. It does create uncertainty, but it also presents opportunities. The more volatility there is, the more it allows us to make investment decisions and adjustments to hopefully take advantage of some of that volatility. So this is not going away. And the one thing that this hopefully has taught all of us is that at the time when the markets were at the bottom, we all knew that the health news, the economic news was going to get worse. And I had countless conversations with many of you one-on-one about, this is not going to get better. This is not going to get better. And, I couldn't say, well, of course it's going to get better. But what we did is we had confidence in the system. We had confidence in what the Fed was doing to kind of stimulate, to boost, to prop up the economy. And we had confidence in that the system and the ability for them to do that. We knew that it was going to get worse. What we didn't know was how the markets are going to respond, and they've responded nicely. And that's one of the reasons why having a long-term focus is really the way you have to approach investing. Because if you're trying to look ahead and say, well, the economic news is going to be bad, therefore my investments aren't going to do well, that would have been a terrible mistake, because this unfortunately did not happen with our clients, but a lot of people went to cash, and there's a lot of people sitting on cash, and their mentality was, I'm going to go to cash and sit on cash until things improve. Well, the markets have improved, but the health numbers really haven't. The economic data really hasn't. I'll show you some stats where it has, but it really hasn't. So what are we waiting for, right? So if you miss this rally of, in excess of 30%, now what? So good. This is just a great reminder of embrace volatility, understand volatility. And part of this is understand what your tolerance for volatility is. And if you can't handle some of this, then we got to readjust your asset allocation, because this is not going away. I'll be doing this for, at least 20, 30 more years, and volatility is going to be part of the strategy, part of understanding how to be a good investor. And that's really what separates good investors from bad ones, is those that understand volatility is part of the process. Got to embrace it. You got to asset allocate around it, and you have to make good decisions. Okay, so getting back to some of this volatility, I'm not going to read through all these slides, and let me get my pointer going here so you can see what I'm looking at. So if you look right here in the middle, this basically shows that during this crazy sell-off that we talked about, the market lost 33%. The best 5 days. So had you been trying to time the market, and when markets had a good rally during this period of time, if you just were out of the market the best 5 days, sorry, let me rephrase this. I messed this one up. The S&P is down 3% year to date. If you had missed the best 5 days, you would be down 33%. So what that shows you is that even though you would have had to ride this up and down environment, that, as the markets have come back, just sitting out the market for the best 5 days would have resulted in a 33% loss, which is pretty crazy. So what we're looking at here, and a lot of you who maybe want to get into the data a little bit more, you can see volatility. So this shows that what we've been looking at, 2020 is these blue lines, and what this shows you, and then the gray represents the 10-year average. So what does it historically give? And you can see markets tend to be, if you can see the data, between on a daily basis between 0% and +1, or down to -1 most of the time. You can see these gray lines. And then if you look at on the outliers, meaning the market's down 3% or up 3%, really over the last 10 years, that happens so infrequently. But what we just lived through over these last 6 months, this was happening 10% of the time on down 3%, and roughly 10% of the time up 3%. So crazy amount of volatility. So Still not normal, but we got to expect this kind of stuff. And then this actually shows the most volatile year over the last decade. So we're actually 2.5 times more than the average. So again, volatility is normal. This kind of volatility, a little bit stretched, but we got to be prepared for it. That's what's going to separate the good investors from the bad. So some of the data that we're seeing on COVID, the daily deaths are declining, but hospitalizations and new cases are increasing. We're seeing that pretty much across the country. So there's a lot of information over here. Our testing is increasing. We're starting to see, the daily number of positives start to inch back up. You're seeing the deaths actually are from a daily death perspective are declining, but there's still way too many. The tally right now is 135,000. And, I know I've had conversations with many of you is like, how accurate is that data? Because I know some of these things have been misclassified, but regardless, it's still a big number. We'll probably get to the bottom of what this looks like, but the trend is still, it's getting to a point where these are starting to be pretty substantial numbers for our economy and having a pretty big impact on families and individuals. Then if we look over here, this is obviously what's concerning. This is why we're starting to see a shutdown, whether you agree with it or not. And I would be kind of on the not category. We're shutting down again. And you can see our daily, the new cases is really spiked. And so, we shut down initially to kind of cause this movement down. And now we're going back through the roof, which, I think many people expected that. If we did one of our webinars about probably pretty early on to this, we talked about, okay, we can bring these down, but we'll probably see another resurgence. Most of the economic indicators were saying this probably would happen in the fall, and it happened a lot sooner. So that's why we're shutting back down. So don't shoot the messenger, just providing some good information here. All right, so one of the things that you're gonna see on a fair amount of these slides is over on the left-hand side, there's gonna be these boxes with percentages. So what Raymond James actually did was they interviewed a group of investors. I actually don't know the exact number, but they do this from time to time. So they created their own survey of what investors, how they felt. So was just kind of their batch of data points. So they wanted to pull from, okay, well, how are investors feeling? And then you can see from couple of these other slides, it actually represents like this is sourced from Bloomberg. So you'll notice kind of throughout the presentation, there's going to be some section where there's this box on the left-hand side, and that's just going to be some of the Raymond James data collected. And so, simple questions: will Donald Trump win re-election? 46%. Kind of going through some of the data. The Bloomberg data is suggesting otherwise. And so, if you actually look at what party will win the presidency, look at the change right here. So, if we look at pre-COVID, you can see the odds were highly in favor of Trump winning re-election, and primarily because the economy was doing so well. And then you can see, obviously, he's gone from an odds of almost 60% down to pretty low odds. Now, we all know that the people who do the polling got it totally wrong when it was Clinton and Trump. So I don't know how much we want to play into these numbers, but it's just a matter of this is what the data is showing. And a lot of it is because of the concerns with what's happening and the economic concerns. And then you can see what will the composition of the Congress be. And you can see that Democrat House and Democrat Senate is now a deep blue line. So what we are seeing, what is polling is a Democratic sweep. I do think these numbers are probably a little skewed, but it's going to be a tight battle and on both sides, and it's going to be a very heated one. And that's kind of that's why this plays into the volatility, is because this is going to drive a lot of emotion and a lot of concerns, right? Because I know those that vote on the right, hoping for a Trump re-election, want to do so for their ideology and maybe tax policy. Those on the left want to change. They're tired of Trump and they want to change. And so we're going to and they're very polarized in their opinions. There's not a lot of stuff going on in the middle. It's a lot of fighting kind of out on the edges, and that's not going to go away. So again, this is just some of the data that we're seeing, and it's changed dramatically since the start of the year. The start of the year, it looked like another split government, and that's kind of my preference, because I feel like anytime you get one party in total control, the legislations can get a little bit, can push the envelope too much and do too much damage to our economic system or our fabric of America. So I like kind of a split government. And I know sometimes you don't get stuff done when you have a split government, but it also, it puts the onus back on us as individuals and business owners and people to take care of their own things versus having too many government policies in place to disrupt that. And that goes for both sides. So I don't know what we're going to have. I'm done predicting because I got it wrong last time. I was surprised by the results. And but again, this is just what the data is suggesting. If you haven't, I can't remember, there's a bunch of sites out there that you can keep track of this on an ongoing basis. It's kind of just some interesting data. So stay tuned for some of that. And here's really the data where it's kind of like even people who are adamant Trump supporters are saying, well, the data's wrong. And, you know, I can't argue with you. I don't do the polling, but here's the data that probably doesn't lie that much, as if you look at approval rating at this stage of the presidency. So if you look at those that lost re-election, which were Carter and H.W. Bush, this was actually their approval rating at this stage was in the 30s. Trump is at 39, and you can see, you know, Truman, Johnson, Obama, you can see where they were at 40, 46, and 48. Trump was significantly higher prior to COVID. So he's kind of in this dangerous area that he's been slipping down into this territory. And then if you look over here, this kind of supports this data. You can see the yellow line with Trump. He was holding his own, kind of going through this, but it's really plummeted kind of from a 50% down to 40. So this just kind of shows that he's not popular. That doesn't surprise a lot of people in terms of just kind of how the general public views him. And, you know, we might have some chance today to get into some policies and some things that are important. I did kind of cover last time kind of my big picture ideas on some of the presidential things that I think our country should take care of. But unfortunately, you're not seeing any of that in you know, any of the rhetoric that's out there. So unfortunately. Okay, so that's just kind of just a reminder of volatility and things that are going to continue to drive volatility. Let me see if I have any questions. So this is a little tongue-in-cheek question. I appreciate it. So it says, should the Democrats win in November, should we sell everything? So I'm okay answering this question. So clearly, hold on here. I'm going to make sure I'm looking at the right stuff. So clearly, you should not sell everything. If you look at the history of our nation, we've been run by times where we've had Republicans majority, Democrats majority, a split government, and our economy continues to persevere. I think it's a mistake to bet against the American spirit and the American entrepreneurism. I just think it's a mistake. I think those are the things that make us successful are the people. And we're kind of thriving in spite of our politicians over the last 20, 30 years. So yeah, I think it would be a mistake. Now, given that, there's going to be potentially some tax policy changes that might impact your view on certain industries. There might be there's going to clearly be more volatility given that. So the question really comes down to this is, I'm not as worried about an outcome generating short-term volatility because I kind of accept that that's just part of investing. The real question is, do you think there's anyone or any party that's going to make permanent lasting damage that's going to change the way our economic future looks? And I know many people say that. I get that from my mom. Like, it's different. I feel bad for my grandkids and this country's going in the wrong direction. I hear that all the time. But I also am a student of history, and I've seen Time article headlines from their covers, looking at headlines from the 60s, the 70s, the 80s. This noise, this disbelief in our system has been there for 50 plus years. And we've continued to grow as an economy. We've continued to innovate. So yeah, there's going to be challenges. Yes, there might be some that will do more harm than good, but generally we're still going to be moving in the right direction. And if we take a couple of steps back, that's just part of human nature. And so I don't think we would want to sell everything. I know we wouldn't want to sell everything. We might want to adjust strategy based on tax policy changes, but that would be my only real concern there. So economy. So we talked early and going through this is that we were clearly going into a recession quickly. It wasn't an official recession, but we were clearly going into it. And it looks like we're on our way. We're essentially mending our way out of this. But this was basically going to look back as like the shortest and deepest recession since post-World War II, in post-World War II history. So, oops, it's not advancing here. Okay. So look at this data here on the left. So this basically shows the duration of the recession in months, and it shows basically the decline of GDP, so the decline of economic activity. Well, this was the decline of economic activity that we had in 2009. It was about a 4% decline, and it lasted about 20 months. So it lasted about almost 2 years. The decline we just have is a loss of over 10%, and it lasted a few months. Well, of course, because the economy got shut down. So this was, really an anomaly. Now we're building our way out of this. And so you can see economic indicators are starting to pick back up. Now, with them rolling back some of the opening up, this is definitely going to be a choppier line. And growth projections are going to be a little bit trickier. But, when you go into this massive slowdown, so this basically shows like growth, what's happening with economic growth, massive slowdown, but then forecasts of improvement are going to bounce back. And we're seeing that data everywhere. I know a few people in the that sell cars, either run dealerships or have their own car lots. And they said that their April was, I think, their worst on record, and their June was their best on record. So what happened is you had a lot of pent up demand because people were not spending money in April. And then we saw all this pent up demand coming out in June. And that's going to continue, but it's going to be choppy, right? Because certain industries are thriving, and we'll get to that a little bit later, but there's a lot of industries that are still going to struggle and continue to struggle in this. But this is basically going to be the shortest and sharpest recession on record. But it looks like it's going to be over, because now we're going to be climbing our way out of this. So the one thing that we look at is, when we look at, well, what's this recovery going to look like? And when you look at the size of our economy, we're about a little bit over a $20 trillion economy. And the things that we don't know is, what's life going to look like for the hotel industry coming out of this? That's 112 billion. Movie theater industry, airlines, flying without the middle seat or flying with lack of capacity. This is just one example of a sports team. Major League Baseball regular season, 10 billion. Income loss due to unemployment, 230 billion. And then restaurants, 240 billion. So there's still a fair amount of unknown in these particular areas of the economy. And the one dynamic with this is that these industries employ a significant amount of our population. I think it's roughly about 20%. But what's interesting is these aren't very profitable industries. And so they actually don't generate a lot of earnings or profits in the stock market. So yes, they employ a lot of people. That's where we spend a lot of money. But these are actually low margin industries, and they don't generate a lot of profit. So these aren't companies that people are excited to invest in for the most part, because they're just not high profit margins. So that's a little bit of the disconnect that I think a lot of people are feeling is, well, why is the market going up so well when clearly there's a lot of businesses that are hurting? It's because these businesses don't generate profits. They don't generate a lot of profits. And that's why there is this disconnect. You got to get into the weeds a little bit more and know what you own. And we'll spend a little bit more time towards the end. Some interesting, data that Raymond James collected. And this was things like, will you be comfortable going to a crowded sporting event? Will you be comfortable getting on a plane? Will you be comfortable going to a restaurant? Will you be comfortable going to work? And look at how low these percentages are. So, in spite of things improving, there's still a lot of concerns out there. I would say Raymond James as a company probably has an older clientele, right? Those in their 50s, 60s, 70s, 80s, 90s, right? So they're not interviewing a lot of 20-year-olds. So this number is gonna be different based on demographics, but clearly going to a crowded sporting event is gonna take some time to get used to, and even getting on a plane. So pretty staggering. I was surprised at how low those numbers are, but then I think because who they're interviewing, it does make a little bit more sense. Okay, so this was, if you recall, we've talked about this, I don't want to say in every webinar, but in many of them. And this really was, the Raymond James team put this together as what they, instead of this kind of idea of like a V recovery, they deemed it the K recovery. And the K recovery was basically looking at 4 different parts of the economy and those that are going to thrive. So if you think about I'm going to just follow this top one here. We have the light blue, which really are medical supplies, e-commerce like Amazon, streaming videos like Netflix. So that's this, and following what happened when the pandemic started is these companies took off, right? Their profits went up, their users went up. And so if you look here, on average, viewers were streaming 8 hours of content during the lockdown, double the pre-COVID level, or pre-COVID levels. Think about that, double the amount of content. Well, people are at home with less to do. So these types of industries were thriving, they took off. These stocks are doing really well through the roof. Then you had the other side is where then you had this kind of lavender, and that's the path they took. Is basically they went straight into decline, and unfortunately, this kind of means no recovery. So the unfortunate part of all of this, we're going to have a lot of restaurants, a lot of local retail, mom and pop, that aren't coming back, and that's really a shame. I don't know how you fix that or how you undo that, but that seems to be the path that this is going to take, kind of in favor of, unfortunately, bigger companies, right? Where people are going to be shopping more online. There's going to be less of that, especially at the local mom and pop. And one of the big reason is because they're very cash flow driven businesses. Companies can't afford to just be shut down. They have rent they have to pay. They have people that have to pay if they were open, but they just can't afford to shut down. So a lot of these businesses are going to shut down. And based on these types of businesses, 60% of businesses reporting sales volume that were declined by over 75%. So massive decline. So these are unfortunately they're going to be the true casualties of this. From a business or economic perspective, are these types of businesses. And so then we start looking at hopefully maybe having a little bit of a silver lining, right? So we have the businesses that are going straight through the roof from here. Then we have the businesses that are now in recovery mode. Home improvements, there's been a lot of money being spent in the Home Depots of the world and the Lowe's. If you talk to contractors or even people, because we're doing a build out of our space next door, and just getting supplies, simple things like, we ordered a new refrigerator and the type that we wanted was going to take 5 weeks to get here. And, that's just coming from, I think, Lowe's or Home Depot. So there's a lot of things on back order because people have been spending money because they have more money because their vacations are canceled. They have all these extra resources. And so they're spending money on home improvements. Surgeries, elective, are starting to pick back up, and then massive amount of money going into technology. And so that's continuing. So then so that's kind of the industry those are industries already on the mend. They're already coming out of this nicely. And then we have this next batch, which is, I think, going to go through another lull. These are the airlines, entertainment, and car sales. So, car sales kind of pick back up, but probably we'll see them fall back off again, and given the shutdown, depending on what happens in a lot of workplace environments. So the reason why we have all these arrows going this way is these will eventually recover. It's just going to take a lot longer. So when you look at the economic landscape, this, the COVID pandemic is going to have permanent, everlasting impact on industries, on businesses, and how people do businesses. And so when I say you have to have optimism in the process, you also have to be flexible in knowing that, things will adjust, and you have to adjust your mindset on what you want to own, what companies are going to thrive, and how do we value companies. And we have a section on equities that we'll get into a little bit towards the latter half of this. Okay, so that was kind of item number 2. So what I'm going to do now is I'm going to go look and see if I have any questions. And so let me just see here. So one of the questions that we have from Phil is retail is in recession and its real estate is seriously affected. So that's first of all a true statement. The retail market is obviously is going to change dramatically, and the real estate's being affected clearly because most of these tenants cannot pay their leases. And so a couple things are going to come out of this. As businesses shut down, new businesses will go into those places. And I know it's a shame for those businesses that are going to maybe lose their livelihood and not be able to reinvent. They might have to file bankruptcy to restructure. And again, this is all a shame. I'm not trying to discount this, but out of this, we're going to have new businesses that are going to form and go back into that real estate space. I read an article. I can't even tell you where it was from, but it really resonated with me because I know that people have been talking about places like grocery stores, and a lot of the local retail aren't going to survive kind of the Amazon world. But at the end of the day, what this article kind of made a case for is you still need that last mile of delivery, right? You still need the local stores, the local grocery stores, those places that are going to be that last mile. Because if you're getting a delivery from a grocery store, you don't want it delivered from 50 miles away. You want it delivered from something local. So the retail landscape, a lot of how all these malls, they're going to have to be redone. Again, there's going to be pain. I'm not trying to dismiss that fact, but they're going to redo how they deliver their value. I don't know what that will look like, but they're going to find a way to do it. We are already seeing that in the restaurant space. A lot of businesses, when they reopened up, if you noticed, they were using, I think it's called the QR codes. I could be butchering that, but I think it's the QR codes that you scan them in, and that's how you can pull up a menu. And now a lot of these restaurants where you scan the menu, so you're not touching anything, it's just your own phone. You go on and you order your food, and you have basically a server bring it to you. So the interesting dynamic that we're going to probably see in a lot of restaurants, it's going to go from a kind of a chef or a cook to a server to a bus person, right? That is actually do your whole experience. And maybe the server goes away, and maybe your tips are actually going to the cook. Your tips are going to the bus people, and there's no more servers. Well, that's that's millions of people that they're going to be out of work. But that's a model that's maybe more sustainable because you can utilize technology to do all your ordering, all the things a server would do. So there's going to be disruption. Things are going to change. It's going to be different. The restaurant experience might not just be this time where you sit and you kill, 2.5 hours. It's going to change. I don't know what that's going to look like, but it's clearly changing. And a lot of these restaurants are trying to adapt. Unfortunately, the closing down of the inside of restaurants is going to make it a lot harder, but these things are changing and will adapt. The real estate owners are going to struggle from a cash flow perspective. Just because they're going to have to revamp their spaces, and they're going to lose tenants that might file bankruptcy. So again, this is not going to be. I'm not saying this is an easy transition, but it's going to be a transition that we'll come out of, and we're going to come out of this fine. So let me see if I have any question. Nope, no more. Okay, policymakers' response. So we're back to stimulus. So why are we back to talking about stimulus? Well, effectively, the federal government created a stimulus package, which was an unemployment piece that provided an extra $600 per week to people who are unemployed. So, and at that $600 extra, people were actually, for a majority of people, they were actually getting more money to stay at home than they were at work. So the reason why the stimulus is now on the table, and we're going to hear a lot of this over the next 10 days, is it runs out at the end of July. So it's now forcing the policymakers to come back to the table, reassess, and say, okay, these are all the things that were broken that we temporarily fixed. What do we need to fix going forward? And this is where the negotiations begin, the fighting begins. I don't know how we want to call that, but that's going to be what we're going to see a ton of over the next 10 days. And maybe we're not going to get resolution because now we're out of panic mode, and so now the negotiations are going to be a lot tougher. Both sides played really nice at the outset because we had to throw money at it to fix it. Now that it's stabilized, it's going to be a much bigger negotiated fight, as it should be, because we can't just keep doling out trillions of dollars without having some unintended consequences later. So a couple things. So the stimulus is crazy. Like when you look at these numbers, and so down here at the bottom, we're going to look at the Great Recession, which was the 2008, the coronavirus, and then the Great Depression. Now, so this is going to be adjusted for inflation because you have to adjust it for inflation. But look at the stimulus that occurred during the Great Depression. That's down here. The reason why the Great Depression became great, and great, that was in a bad way, was because the response to what was happening was completely wrong. The government at that time, and there's a great book, I think it's been a while since I read, I think it's The Crash of 1929, talks about all the mistakes that the Federal Reserve did, all the mistakes that the government did in terms of pulling in money, tightening lending. It just sucked all the money out of the economy. So now most of our Fed policy is, if we have a slowdown, flood the system with liquidity. That's their new playbook because they learned from the Great Depression. So if you look here, look how late the stimulus came in. I mean, we're talking about, this is number of days. So this is almost 4 years before stimulus started, and then it occurred. So what we're seeing right now is the coronavirus, or COVID-19. You can see the blue represents what we've seen so far. The Great Recession now dwarfs in comparison. And then the forecast, meaning this next little batch of stimulus, looks like it might be another big number. So you can see on the right and on the right of this shows what the Democrats want and what the Republicans want. And I'm not going to get into too much time on what I think is better or worse. It's a really challenging conversation. So Democrats are trying to make sure state and local funding is shored up, because with a lot of the slowdown in spending and economic activity and tax revenue, the states are really going to be hurting in many cases who weren't, budgeting properly. They're going to see massive, they're going to have to start making some cuts unless the federal government comes in and provides some bailout. That's going to come. I don't know to what degree. It's probably going to be politicized, and what states get the money, who gets the most. The Republicans would like a payroll tax cut. I think they view that as like an immediate aid to the economy. The question is, does everybody get it? So that's going to be, I think, one of the kind of philosophical challenges that we have. Do we give it to everyone just so that it's fair? Or do we say, you know what, we need to be more focused and say, if you're in this industry, this industry, this industry, this industry, we're going to give you this dedicated focus because we know you're hurting, where if you're in these other industries, you're not. So it's going to be a real challenge, right? Because do we want the government to pick winners and losers and say, we're only going to help these people and not these, or are they just going to do a blanket across the board? So that's a bit of where the fighting is coming in. And again, that's where it should be coming in, because you want to make some good decisions. And so it looks like everyone wants to increase funding for the payroll protection program, the PPP. And then you can see just some of the things. Liability protection is something the Republicans are pushing for, basically limiting liability of businesses, so that if I get COVID if someone gets COVID here, that I have liability protections. If you go to a restaurant or stay in a hotel and you get it by staying there, that you create some liability protection so you don't have all these lawsuits coming out of this. You're seeing one of the things that the Democrats definitely want, which is not on the Republican side, is how do we extend some of the unemployment insurance boost? They're looking to push this out till next January. I have a concern with that. I think just primarily because companies that want to get back to work, if you can't find people because they're getting paid more to stay home, that's a problem. But we also have to realize that if we're shutting down a bunch of these industries again, we have to figure out, well, how are we going to provide these resources? And so is it going to be across the board, or is it going to be based on certain industry codes, certain industries? And then you can see some of the things the Republicans want to do, putting in hiring tax credits, corporate tax credits. So you can see how they tackle problems, right? Republicans tend to be a little bit more top down, Democrats a little bit of bottom up, a little bit more bottom up. And I think the right combination is going to be a little bit of both. And so I could probably spend a whole hour on this topic of where I think they should be spending money. I won't get into that today because it's not super relevant, but they'll work through this. I just hope it's not too big. I think we've stemmed the panic. Now we got to be a little bit more focused, because it's just not healthy to keep giving away trillions and trillions of dollars. It's not a good thing for our economy to create that system where we're just doling out money unconditionally. So I think we have to find that happy medium, and we'll be working through that. It's a political year, so my guess is both parties are going to say, hey, let's put money out there because they want to please all the voters. And that's maybe that's sometimes my cynical view of the political system, but I think that's what's going to happen here. There's going to be money that's going to continue to flow, because I think both parties want to err on the side of not upsetting their voters. Okay, so one of the things that we talked about was this idea of what federal unemployment the federal unemployment booster did. So this data was staggering. I just saw this chart when I was preparing for this. And so as a reminder, that insurance booster was this extra $600 a week that was provided. So look what happened. This shows that compensation of employees and compensation plus unemployment insurance. And that's what this line is. And so you can see right when this hit, compensation and compensation plus unemployment insurance dropped 4% and 8%. If you add the unemployment insurance booster, their income actually went up. So that's what I was referring to, is that there was actually more cash flow coming into the system, more cash flow going to workers than were actually being earned in a normal time. So again, this is the line that shows how much people were making working. And then you got this massive boost once this stimulus went in. So I think I would definitely support maybe getting back to this levelized number, but I don't think we need this extra stimulus at this time, because again, we stabilize things. And then you can see some of the polling, and this is kind of the concern over here, is these widening budget deficits. You look at Florida, Hawaii, Illinois, California. So California is an example. Fiscal year 2020 budget deficit was projected to be about 5 or 6%. Good news is we actually had a fair amount of reserves that we can use. But then our budget deficits are projected to be minus 20% for next year, which is a massive problem, because that impacts teachers and police and fire. I mean, it impacts the budgets of all the state and local governments. And so this is going to be a big challenge to see how we're going to manifest it, how this will manifest itself. How do we fix some of these issues? I also think that California is going to be surprised at how much revenue they're going to get from things like capital gains. There's a lot of stocks that are doing well. So I think there's going to be some surprises going into next year. Kind of the wealth effect that houses have gone up in value. The stock market is now coming back, and especially in the tech area, hitting all-time highs. So I think that's going to generate a fair amount of tax revenue that they're maybe not expecting. So I think this is being a little bit overstated. But we'll see. But the federal government's going to have to provide some stimulus to help backstop these governments because they don't have the printing press. Remember, as a federal government, we have the Federal Reserve who can print money. California doesn't have that mechanism. States don't have that mechanism. And so that's where the federal government will come in and try to shore up some of the budgets to make sure they can operate. Okay, so the one thing that I've been getting a lot of questions on is inflation. For the foreseeable future, inflation is not going to be a problem, and either will interest rates. Interest rates are going to stay low for several more years. The Fed has talked about leaving them low for 2-3 years. So what that means is your cash is you're going to be earning 1%. We've seen money market rates plummet from like 2%, and they kind of moved down, and now we're seeing things at like 0.15, 0.1%. So cash rates are getting really poor, which is forcing people to decide to go take risk, going to take risk with the stock market with investing their money, because sitting in cash, obviously you're going to lose money against inflation. And then if you look here, inflation well below targets. So the Fed target is around 2%. And you can see over the last 10 years, they haven't been able to generate that much inflation. We might get a temporary spike up of inflation because of all the stimulus money going into the system, but it's not going to be sustained inflation for now. That's going to be a later item. When I say later item, it's hard for me to predict the future, but I think that's an item we're going to be discussing in 10 years, not in the next 2 years. So the Federal Reserve I think wants to try to create some inflation to get the system back on track, but because inflation doesn't seem like it's going to be an issue at this time, we're going to basically be looking at low rates for 2, 3, 4 years. And I've talked in the past, I think we're going to have low rates for decades to come because our government owes $25 trillion and they don't want to refinance their debt at higher rates. And so they're kind of incentivized to be in a low interest rate environment for the foreseeable future. Okay, so we're going to go into equities real quick. So hold on here. Let's see if I had a couple questions. All right. So one question is, let's see here. States will have to reduce capital investments into public projects affecting construction employment. So that's a great question, Phil, or more of a comment, right? So the states are going to have to cut back on some of their programs potentially. Part of some of the stimulus things that they're talking about putting into place is like a special infrastructure bill. So instead of just handing checks to governments, is to actually create infrastructure spending bills, and so that things can actually get done. And I think I'm more of a proponent of this approach. Is like, what we have in many cities and states, crumbling infrastructures from roads, bridges, things like that, is to get that money to use in terms of getting things done to improve our economy, help, revamp airports, things that will improve the infrastructure of America and get us ready for this, the century that we're in. We need a big improvement there. So while I think there will be the cutbacks there, I think that's where some of the infrastructure bill money will come in. But what's interesting with that is the unemployment piece and the infrastructure bill might fight with each other, right? So I don't know what a typical construction job is, but let's say you're a construction job and you're at $25 an hour, and you're getting paid $27 an hour to stay at home. So that's one of the things that our politicians are going to have to be really careful with putting these things in place, because you don't want to have a bill set up to fuel spending and building, but we can't find the people to do it. And that's one of the other challenges we're still seeing with a lot of employers, is they can't find people that want to do this work and want to do a lot of the work. So yes, there will be some cutbacks, but again, I think that's why they're proposing an infrastructure bill project. So I got another question from John. Do you think we go negative rates? And if so, what impact could that have on the markets? And so negative rates basically are when the interest rates go below zero. Now, I studied economics in college, and that was unheard of. It was almost something that was impossible, that could not occur. Well, we've had negative interest rates in Europe. We've had negative interest rates around the world. We talked about that in previous workshops. And most of the economists that I listen to and read do not think that negative rates are a possibility here in the US. So that's kind of consensus. I don't think I think our economy is still too healthy to go negative rates, because the idea of negative rates is crazy, right? So imagine if you had a negative interest rate mortgage. A negative interest rate mortgage would mean you'd have to make no payments. It would pay itself off because your interest rate would be negative. So I'm sure home ownership would spike if everyone could just get mortgages where they just paid themselves off over time through negative rates. And so the consensus is that's not going to happen. I think low rates is going to be sufficient, because the other thing too is the US dollar has been really strong because a lot of capital from around the world has been coming here. Money that's in Europe sitting in banks at negative rates, it's finding its way to the US, which is also helping us innovate because we have inexpensive money and we have a lot of money continuing to come in, which is helping to fuel our entrepreneurism. So our capitalist system is working because money is coming in here. So I don't see negative rates as a possibility, but anything's possible. But I do think interest rates are going to stay really low. When I say really low, we're having mortgage rates in the 3-4% for a prolonged period of time. Could they go down to 2? Potentially. But I don't think we're going to see that now. I think this is going to be, if we see rates that low, it's going to be at a later time. But I don't have a crystal ball on that, but that's a great question. Okay. So let's talk a little bit about equities. So at the end of the day, equities seem to be an attractive place, especially when you compare them to alternatives, right? So stocks over a long term, and the past does not mean it has to repeat in the future, but stocks over the last 100 years have averaged in like that 7 to 10% range. And even if we're going to go into a dynamic where stocks are going to average less, what number are we okay with? What if it only averaged 5? What if it only averaged 6? Would that be good? I guess the short answer, compared to cash at 0 or bonds at 1 to 2, 5 or 6 doesn't sound so bad. So one of the things that's interesting is that returns might have to come down a little bit compared to historical norms, but they still will likely over time surpass a cash or cash alternative, but with volatility. That's why I kind of led and started with this volatility. So if we look at a couple things, so we basically had the worst quarter in a decade, and the second quarter brought us the strongest return since the fourth quarter of 1998. So that was the kind of the bounce back. And it was really one for the record books. We haven't seen this type of volatility. Now, what the interesting thing with this is if you look at these little peak periods where we had massive amounts of upside volatility, so this just shows percentage growth. So massive amounts of volatility to the upside. And these essentially, I think it's 8 periods. How did the market do after those strong quarters? And if you go back to 1945, those 8 quarters, that the returns, looking forward, are generally higher. If you look 3 months ahead, basically it was 100% of the time that they're higher. If you go 6 months ahead, 100% of the time the markets were higher. And if you go 12 months out, almost 90% of the time. So the data would suggest that this bodes well for the economic recovery to continue, the stock market recovery to continue. But again, that's just looking in the rearview mirror. That doesn't necessarily mean that that's going to have to play out that way. But data would suggest that strong quarters are followed by future strong gains over the next 6 to 12 months. So we expect that to continue to happen. The other thing and this is a little bit of the education we were going through during the middle of the recession, or the middle of this sell-off, is that when the markets bottom, it's generally before the end of the recession. So this chart kind of shows the average recession, just looking back over our history, the stock market sells off. We have a bottom, but then the end of the recession doesn't occur for, 3-4 months or so. And so, that's how long it takes to get back to there. And so we've seen this big recovery on the markets. Recession by most accounts is technically over. And, then you can see how well the markets do kind of coming out of that. So we think that that's likely going to bode well, that we'll see some decent stock market performance. But there are some concerns, and I'll share that with you. But typically, and again, there's just tons of data on here. I don't want to go through every data point, but typically markets do better coming out of the recession, even though you might have missed this big early bounce in some of the accounts. If you were in cash, let's say, fortunately for many of you, that's not you. but we still have some room to grow. So if we start looking at what's going to probably drive that, there's a rule. There's one of the main rules to investing is do not fight the Fed. So don't fight the Federal Reserve. And the Federal Reserve is basically providing liquidity. When they print money, they put money into the system. You can pretty much track how risk assets do. When I say risk assets, that would be real estate and stocks, how they do over time. And when the Federal Reserve is printing money, putting liquidity in, those assets tend to go up. And so what's pretty staggering is look at the amount of money right now that's in money markets. So this shows you how much money. So basically from this period of time, right when this started, our money market rates have hit all-time highs. So why is that so significant? So that's basically like pouring gasoline on a fire, right? So if you think about our stock market has been doing well, and the alternative for a lot of investors are they're sitting in cash. They're sitting in cash because they're nervous about the future. Well, once some of this gets kind of worked through and we get back on some path of sustainability that people have more confidence around, what's going to happen with that cash? People aren't okay sitting on $4.8 trillion of cash making almost 0%. So that money is going to find its way out. So as that money goes and gets invested, it's going to drive up prices, because what's the thing that we know about investing? What makes the price of something go up versus going down? When there's more buyers than sellers, things go up. When there's more sellers than buyers, things go down. So the simple fact that we have this level of cash on the sideline is going to create a lot more pent up purchasing of the markets. And that's actually what you've seen. So this recovery has been pretty swift to the upside, but what you have seen is these from week to week, some bad weeks, but those bad weeks have been followed by good recoveries, because people who are sitting on cash say, okay, markets went down 5%, 6%. Okay, I'm going to put some of my cash to work, because they missed a lot of that early rally. And so this is a good sign. If you notice here in 2000, at the height of the financial crisis in 2009, look at how elevated the cash was. This was the start of this economic boom that we were in. And you can see once the market started recovering, cash levels got back down to a normal level. So if there's a bunch of fuel here for this economic growth or for the stock market growth, it's going to find its way in. And you're already seeing a little bit of that start to go in. So if all the money's in the market, the markets can't go higher. But because there's so much money still on the sideline, things can go higher. Sorry, I was just checking on my time. Okay, so a couple more slides we'll go through as we kind of wrap up for today. So I know one of the concerns people have is markets are getting overvalued. So it is true that valuations are near multi-year highs. So you can see valuations are primarily measured using PE ratios. So price earnings ratios, we're seeing that the market is kind of pushing close to 2000 levels. I think that's making people nervous. Part of why that's there is twofold. Number one, pricing has come back up, but also earnings have dropped. So remember, price divided by earnings, the earnings component, when you have the economy shut down, earnings plummeted. So part of this kind of spike is just because earnings have temporarily declined. We think those earnings will come back. So valuations are at a high, but when you start comparing them to the alternatives, back here in 2000, you could have invested in a CD and gotten paid 5%. Now that same CD is probably 1%. So it's a little bit different valuation method. So this is not concerning at this time, but these are things that we always keep an eye on to make sure things aren't getting expensive. There clearly is some political uncertainty with the election. That's going to drive volatility. I do want to go through this a little bit technical. I like this slide, but as I was kind of preparing for this, I wanted just to kind of share, it's a little bit technical right now. And if you look here in the middle, there is a potential that money might be leaving equities, might be leaving the stock market, because if you think about the big money managers, those that manage pensions for companies or pensions for the state, because the stock market has rallied so much, we're seeing that their equities are a little bit elevated, meaning they own more than maybe their target would suggest. So we might see some rebalancing that's going to occur, which would lead to some shorter term volatility. We're viewing that as a healthy thing. And if you actually look, this happened back in 2009. If you look at this chart, the light blue shows what our market has been going through. The dark blue shows what happened in 2009. So right off the initial recovery, the markets kind of jumped up, and then you can see they went through a little bit of a sell-off here where the markets kind of corrected back. Now, this is not a huge sell-off. It's maybe 5 or 6%. So we do think that there's a high probability we could see something like that. But here's kind of my high-level question for you. And so if we're here right now and we have confidence we're going to go here, which is higher, do we really want to be trading for the short-term volatility? We don't. The reason why we pay attention to this stuff is we have clients who are sending money into us on a monthly basis, on a frequent basis. They're selling assets and we get checks on an ongoing basis. And so when we're putting that to work, we have to really understand where we are in market cycles so that we can decide, are we going to invest it all today, or are we going to spread this out over a few months? But this does not give us cause for concern to make decisions about, you know what, I want to avoid a little bit of this weakness because we think the markets will continue to move higher. So again, wanted to share this with you, but near term, we could see a little bit more weakness, which is going to be fueled by a few things. The fact that the markets probably need to pause, number one. Number two, with the cases spiking and more of the headline news becoming concerns, we're definitely going to see the markets are going to maybe go down, and then people are going to say, this is going to go way down again. So it'll kind of breed more selling. But we do think this will be a temporary move to the downside, not a permanent move to the downside. Okay, so Raymond James and their analyst team, these are kind of their overweight sectors that they prefer: technology, communication services, consumer discretionary, and healthcare. Kind of underweight in some of these areas. So like Phil asked a good question about real estate. That's why they're underweight there. We have some real estate exposure. It's not big in the portfolio, and many it's like 4 to 6%. So we still want to maintain diversification. But what's pretty mind-blowing is actually the weightings of the S&P. So, you know, there's a lot of concerns right now what's happening in the energy market. Well, the energy market is becoming less and less relevant. Look at the energy space. It's only 2.8% of the overall market. Real estate is only 2.8%. Technology is 28%. And so in those areas that are growing the fastest, we're lucky as a nation because the US has some of the best companies out there and we're growing faster, which is why our economy is going to be more resilient. And, you know, and healthcare is another sector that we're doing really well at. And here's just kind of some of the high level things that I thought was really kind of interesting to share with you, just some of the Raymond James investment strategy team, some of their thoughts on why these sectors. Well, first of all, technology, because technology companies can grow without adding a lot of cost. So that's where the big benefit there have. Plus, you're seeing a massive change in the networks going from a 4G environment to 5G and the benefits of working from home. So people are going to have to rethink their technology, what they're going to need, their hardware, their software. It's going to change, and you're already seeing that occur. That disruption has really been in place. Getting access to even like the webcam that I'm on is back ordered for 4 months. So there's a lot of things that are kind of pent up, which are going to drive that infotech sector. Healthcare, aging demographics were already driving this, plus all the new breakthroughs we're seeing in like genome and different types of DNA sequencing and things that are really innovative. We're seeing that's continuing to move forward. And then obviously the push for a vaccine is a big one. So the healthcare space is going to benefit from this. Plus the healthcare space is getting a lot of resources from the federal government because they're trying to make sure they have all the PPE to make sure that all their workers, their frontline workers, can be working safe. So there's a lot of resources and money that's going into this space. And then the other two, communication services and consumer discretionary, kind of goes without saying, right? The broadband space, the 5G, what we're seeing with it, what's going to change with our phones, and then also consumer discretionary, really the move to e-commerce, really embracing the Amazon model, kind of forcing a lot of the other types of companies and industries out. So the other thing too, consumer discretionary, I know people are concerned with the consumer because of how high unemployment is, but right now debt payments are basically at record lows as relative to their disposable income. So the consumer is still pretty healthy. Now, you get rid of unemployment permanently, that extra 600 booster, that's going to change the dynamic. So, you know, this is a fluid review of what's happening. This is not a one size fits all, we're all going to be fine. We have to be evaluating it. Those are the things that we're doing with the portfolios. Those are also things when we're looking at our managers that we're selecting, we want to make sure they're making those nimble decisions with how they're managing their portfolios. And those are the things that we're researching and we stay on top of. I don't want to spend a lot of time on this because I think I ran a little bit longer than I would like. But just real quickly, people are talking about valuations and that the tech sector is expensive, the healthcare sector is expensive, and communications expensive. Relative to the S&P, relative to the market, it's actually not as expensive as it would appear on paper. They still seem to be relatively attractive. And so even though they have grown and they've done well, despite their outperformance, they're still not crazy expensive. This is not, in our opinion, a repeat of the .com. There's a lot of companies that are high flying that are doing well, but they have real business models. They have real profits. This is not a repeat of 2000 yet. So markets always like to find a bubble to burst. We'll get there. We just don't believe we're here now. And those are things we're trying to keep an eye on, make sure we diversify and asset allocate appropriately. So as we wrap up, let me see how we're doing on questions. I got a couple here. Let's see if, unemployed will lose medical insurance. Lack of medical insurance was a problem before the pandemic. How do you see this issue being addressed? Well, that question really depends on who's in the White House, correct? So we know that the Democrat solution is more of a Medicare for all type one payer system, and the Republicans are proposing more of an open market. And so depending on what happens in the fall is going to really be the answer to that question, is how are we going to address that? If people are unemployed and do not have income, they will qualify for Medicaid, right? So that's a good question. It's a very big question, right? But it really just depends on the policymaker. If we have 4 more years of Trump, it's probably not going to be addressed, other than maybe him trying to dismantle Obamacare. He might just leave it alone and go about his business on other things. But if Biden wins and the Democrats control the House and the Senate, there's likely going to be some more medical reform, probably building on the Obama legacy, right? So again, and there's pitfalls to both sides, but I don't really have a good answer for that, because it's really going to depend on who's in Washington. And I think that if it does flip over from a Republican president to a Democrat president, that will probably be one of the higher priority items for that for that term. Where I don't know if it's going to be a super high priority on the Republican side, because I think they'll take an approach of get people back to work, get people back on employer insurance, and let's focus on the economy. Again, that's just more of that mandate, but we just don't know yet. So 10 lessons. So this is just kind of a high level, 10 things investors should remember. So number 1, take care of yourself. We've got to have mental sanity in terms of making good decisions. Stay calm and do not panic. Don't make emotionally charged panic decisions, right? That's just so important. And we lived through that. Like this was a challenging 4 months to go through with all of you. And, hopefully we were good stewards and we gave you good advice and provided some calm, but, there were some weeks there it was not fun. But, we stuck to our discipline of maintaining our allocation and being disciplined, and that's what you pay us for. That's why you hire us. And, a lot of it is because we have faith in the plan. So number 3 here, stick to your plan. We created the right allocation for you when the markets were calmer. Don't abandon it at times of volatility. Volatility is going to show up. We don't know how it's going to show up, but it's going to be there. We have a plan in place. We stick to that plan. We adjust, but we don't abandon. We don't just say everything's different. It's going to blow. The economy is going to blow up. Again, we have some faith in our system. We have some faith in the way our economic system has been built. Make sure you're properly diversified and know what you own. That's critical. A lot of the calls we had with you is, do you have cash on hand? Do you have enough cash? Do we have cash reserves? Are you properly diversified? It's a big important thing, because you can manage through that. Remember your time horizon. When you have a 20-year time horizon, what's happening over a year is somewhat irrelevant. Oops. Okay, last slide. So I guess jumped ahead. Have cash on hand for short-term liquidity needs. That was our biggest concern. We were having conversations with clients of, I don't know when this is going to end. I don't know what the future is going to hold. Do you have 2 years of cash? Do we have cash reserves? And if the answer was yes, great, we can kind of weather this. If the answer was no, what do we need to do to maybe build up some more cash just in case? That's a big thing, is have cash on hand for short-term liquidity. And I don't mean cash sitting in a safe. It can be a bank account. Shoot for the stars. If you look over here on this American flag, this idea of shoot for the stars, and this basically just shows on the left-hand side, average annual return and standard deviation. Standard deviation just measures volatility. And there's this, what's known as like an efficient frontier. So over time, 100% US equities will give us the higher return, but with the highest amount of risk. And then if you have 100% in bonds, you don't quite have you have the lowest return, but you don't have actually the lowest risk. So the whole point of shooting for the stars is review your risk tolerance. Where should you be in here? We spend a lot of time with you on that. That's where we spend a ton of our time with our clients. Rebalance your portfolio, right? Your allocation is going to vary between stocks and bonds based on what's going on with the market. That's part of our process to rebalance, stay on top of things. tax loss harvesting in your taxable accounts were the things we could sell to generate some tax write-offs. We did. Dollar cost average. So as new money is coming in, we have a weekly meeting run by Tyler, who's managing cash coming in, and we're dollar cost averaging. So we're making decisions on a weekly basis of putting cash to work. So we're not just diving into the deep end. We want to make good decisions. Dollar cost averaging basically means smoothing out. Instead of investing at one time, we invest over a period of time. One of the things that the media is driving all of you nuts is this idea of the percentage. Oh, the Dow went up 1,000, the Dow went down 1,000. The points don't matter anymore. It's the percentage. So look at this. 1,000 points on the Dow is now is basically 4%, while 1,000 points in 2009 was 14%. Way different scenario. So just remember, as these markets hit higher and higher levels, the points aren't as significant. It's the percentages that really matter. And then the last part is remain long-term optimistic. You know, to be a good investor in real estate and stocks, you have to have that long-term optimism that we have some inflation built into our system. Inflation meaning prices are going to rise over time, which means you want to be an investor in assets that are going to grow over time. Companies are going to innovate. Companies are going to sell more products, and that's going to cause their value to go up over time. And that's a big part of what you have to do is have that long-term optimism. But, you know, remember rule number 6, have cash on hand for when things don't go how we plan. And so, you know, we're here to help. We're going to do this. We're back on a monthly, I think I'm wrapped up. Let's check real quick. Yeah. So we're going to go back on a more of a monthly plan, but if things get a little haywire and I got to go back to every 2 weeks, I'm happy to. I really enjoy this. I wish I could see your faces and answer questions live. Hopefully we're not too far away from that. But we know probably not going to be this fall. It'll probably be next year at the soonest. So, so I just got a couple of not questions, just thank you. So I hope you guys enjoyed our content today. We will, as a reminder, you know, share this content on social media. I know this presentation is a little bit long, but you know, we're trying to do our best to really get out there and provide good information. There's a lot of noise out there, and we think it's critical for people to be in a position, where you're in a healthy financial position with lower levels of stress, lower levels of concern. And a big part of what we do when we focus on planning is to help alleviate some of that stress. We don't know what the future is going to hold. We don't have a crystal ball, but you know, our job is to have discipline, have faith, and have a process, and be there to answer questions when things go awry, because we know that's going to be part of the rest of our life. Is we're going to have chaos, we're going to have volatility. So a big part of that is embrace it and be okay with it. And if you're not, that's okay. You can call us and we'll help. So I will talk to you all in a month. And thank you. Stay safe, and you know, I hope your family is healthy. And I'm going to sign off. So thank you very much.